What's the year-end outlook for bond rates? Remember, kids, when we talk bond rates, we're talking mortgage rates, and we're also talking discount rates for future stock market earnings. So it is very important. And joining me now is David Goldman, Global Head of Fixed Income Research at Cantor Fitzgerald. Our panel is still here. Craig Columbus, I want you to butt in. I want you to say something. These guys are tough. You got to speak up, Craig. Get ready. All right, Dave Goldman, by the end of this year, the 10-year bond, which today is about 460, where's it going to be?
465 to 470, Larry. Very little change.
Why isn't it going to be 4% with the slowdown that Joe Lavorgna is talking about and the energy deflation, not to speak of the Fed excess tightening that I'm talking about? Why won't it be 4%?
Well, the bond inflation premium has dropped about 30 basis points, really in lockstep with oil, as we've gone from around $80 to $56 on oil. If you're telling me that oil's going to go to 40, yes, we could have another 15 to 20 basis points drop in bond yields.
Well, what about, wait, 40 is, we might get to 40, but first we get to 50, and then we get to 45, and Saudi Arabia is not going to stand in the way.
Well, if you give me an oil forecast, I'll give you a bond forecast. I think 50 is a reasonable number, but I think we've seen most of the oil effect. As far as the real effect's concerned, 2.5% growth, 2.5% tips yields is right about on the screws. There's no particular reason for the real yield to drop that much more. We've seen real yields come down about 25 basis points at the 10-year level. I don't see any reason, unless the economy does a lot worse than I expect it to, for that to happen. But
and the inflation spread has come down quite a bit. I don't know if we can put the chart up or not. We tried to put some charts up on your tip stuff, but the inflation spread has come down from 200 and no, that one's a long run. That doesn't tell the story. But actually, year to date, the inflation spread has gone from 270 basis points all the way down to 210 basis points. That's a big drop. Of course, it has a lot to do with energy, has a lot to do with the Fed tightening. Let me get some help on this oil question. Craig Columbus, what's the price of oil going to be in the next 3 to 6 months?
We think between 55 and 60.
Oh, so you're on the high side.
Absolutely. You know, one of the things, Larry, we talked about the Democratic Congress, and in our work, you know, it reminds us a lot of like sort of the Daschle period, because one of this, you take a supply initiative off the table. That is, Bush would veto a windfall profits initiative, but you take some of the offshore supply initiative off the table, plus the Tories in Canada boneheadedly reneging on that dividend, on the royalty trust dividend tax cut on that side. And I think that the supply initiative will cause stabilization here in oil.
Joe Lavorgna, do I get any support from you for $50 oil or maybe 45?
Larry, probably 45 to 50. I mean, if the U.S. economy slows, the demand for commodities in general will weaken and oil prices could dip a bit lower. And I believe our commodities team also sees oil coming down a bit over the course of 07.
So, Joe, what's your 10-year bond rate forecast by the end of the year?
I think it's going to be right around here, maybe a little bit lower.
How about by the end of the first quarter in 07, after the Fed eases at least once and probably twice?
I think 10s can make a run, Larry, to 4.25, at least intra-year. I think what will happen is as the economy recovers maybe late next year, yields back up a bit and the curve steepens. But I really won't be short 10-year notes here. I think if the economy is as soft as we think and the Fed's cutting, you don't want to be short duration.
All right, Dave Goldman, you heard Mr. Lavorgna, top bond guy at Deutsche Bank. What do you think, Dave?
I think the October CPI drop, Larry, was a blip. It was due to the drop in oil price, but even more due to deflation in vehicles prices. All the service numbers were up by 5 to 7%.
Well,
and that's what the Fed's going to be looking at.
I hear you on that.
Right or wrong.
It was the second consecutive downward blip. There's a pattern here. And by the way, let's not forget the tight money. The Federal Reserve has been tight as a drum. And if there's one thing Milton Friedman, bless his heart, rest in peace, taught us, it is that fluctuations in monetary policy will affect the economy and inflation with a lag. And I dare say in this information economy, those lags are very short. Doug Kass, where's the 10-year bond going to be at the end of the year?
I think we're going to get a recession scare of real major proportions, and I think there is a possibility that the 10-year goes under 4% sometime during the year.
375.
Yeah, I think that you can have a meaningful appreciation in 10-year bonds. I do think we are all misinterpreting the inflation figures. As you know, I'd rather look at the trim mean PCA indicator that the Dallas Fed uses, and it's still well above the 2% comfort zone. Look what United Parcel Service did today. They raised prices for their services by 4.9%. Why? Because their costs are rising. Everyone's focused now on energy and natural gas. What about live cattle?
What
corn,
about hey,
wheat,
Doug, what about
the
home
price
prices?
of coffee?
Hey, Doug, what about home prices?
Home prices.
And what about technology prices, which are falling? And what about capital goods prices, which are
equivalent rent
falling?
is
I
the
mean,
most
come on, let's go
ridiculous
through the full panoply. You guys are in denial about disinflation. I can't stand it. You're all in
What
denial
about unit
about it.
labor prices at a 16-year high? What about productivity at a 9-year low?
Well, they
what
haven't
about
made
the
any
absence
money. The workforce hasn't made any real wages in years. Now they are because gasoline
You finally
prices are
admit
coming
it.
down.
Larry,
You finally admit
the
it.
point is the Fed is going to be in denial. They're going to be fighting against what they perceive as inflation expectations, trying to dissuade people from doing the kind of things that UPS did today. They're not going to cut till the end of the first quarter. They'll probably cut too late when they do, but that's typical Fed behavior. You're asking for a forecast, not for justification.
No, I'm asking for a forecast, and I say it's going to go. I agree with Kass on this. I don't know about 3 3/4. I think Lavorgna is probably right. Michael Darda, on the way out, we're going to post charts you're going to love. The commodity index, spot commodities, which excludes oil and gold, and also the Goldman Sachs industrial commodities. They're both strong, Michael Darda. Tells me the world economy is still in pretty good shape.
Going to be cutting interest rates anytime soon. There is no value in the long end of the Treasury curve. None.
You want to sell bonds? How high is the bond rate going to go, Michael?
Well, I think at a minimum it'll drift up to the Fed funds target next year. Even if they just hold rates steady, I still think it's more likely the next move's a hike, not a cut.
What then? How high will the funds rate go in your scenario?
Ultimately, I think that rates peak at about 6%, long and short.
6%. Joe Lavorgna, what do you think about a 6% bond rate and a 6% Fed funds rate?
I think we could definitely get there, Larry. We're going to get to 3 first, though, before 6.
Okay, that's great. Panel's going to stay with me. Dave Goldman, thank you ever so much. Up next, the retail rally. It is this year's greatest story never told. The best of the best is coming on. Ms. Dana Telsey, she's our fave. She's going to preview holiday shopping and tell us, frankly, whether 20% higher and later we should stay with the RLX. And then coming up later in the program, money politics. Remember, folks, only 718 days till the presidential election, and we are not wasting any time. Our all-star panel is ready to weigh in on Giuliani versus McCain and Hillary versus Obama. Stay right where you are. Kudlow and Company. Lots more work to do.